All right, everybody, let's get started. How are we doing? Good. Well, happy Friday. Hope you're doing well. Welcome to our topic talk. So I'm kind of here to orient us before we invite our speaker Laura up to the stage. As you see up here, we have a different QR code than we had at the beginning. So this, if you want to scan this, or you can go to www.menti.com and enter the code. This is going to have a couple questions for you guys, just so we can kind of set the stage today for our speaker. So if you just want to take a second to do that. Okay, thumbs up. Is everybody close to in? Okay, perfect. All right, so we have our first question. Where are you guys in your professional journey? So there's kind of a scale for student, early career, mid-career, senior leader, and retired and giving back. So select whatever best fits you guys. Looks like we have a pretty heavy student leading, mid-career. Okay, no early careers. Okay. Next question, how much do you know about today's topic? And it's okay to be honest, not much, some, or a lot. Okay, about like a 57%, not too sure, that's okay. And our last question, what do you guys want to do with today's information? Would you like to be inspired, learn it, or apply it? Perfect. Looks like applied it is the winner. Perfect. So if Graham, I'll swap it off to you. He's going to kind of introduce our speaker today.
Happy to do that. Thanks, Ella. Too many things now. All right, we were just joking over there that Laura's going to do her best to inspire, even though only 12% of you want to be inspired. She will inspire you. I'm sure of it. Well, I'm really excited to welcome Laura to the Hub today. Laura's a William & Mary alum, and she's bringing today an investor perspective, but also an operator's perspective. And so this is going to be a really unique talk. She's a general partner at NRB. She's invested more than $75 million into early stage companies through that role. And interestingly, she's also serving as the CFO of Farmer Focus. So you might notice or recognize that label. Yes, that's the label on the chicken that you bought this week. That's a portfolio company of NRB. So she's got that perspective of an investor in that company, and also on the other side as an operator using the funds that have been raised. She earned her undergrad degree here, double majoring in English and accounting. And she did that double major before double majoring was the really cool thing to do here. And she then also got her master's degree in accounting. And then she went to another school called Columbia, and she got her MBA. I'll give them a shout out. So today's topic talk is going to explore the realities of fundraising. So often we want to try to dispel the myths related to entrepreneurship and entrepreneurial thinking, and we're going to do that today related to fundraising. How do you choose the right capital? How do you find the right investors? Not all money is equal. And how to avoid the common pitfalls and mistakes that founders make. On a personal note, I've had the pleasure of working with Laura before, and I was thinking about this. If I ever got to like pick a dream team of people that I would get to work with on something, Laura would be on that team. And in fact, she'd be on the team before I made the short list. Like we'd make the short list together. She's really, really smart. You're going to see that in a second. I'm setting the bar here. She's humble. See, it's happening. She's humble. She's flexible when she needs to be, when it serves the needs of the shared goals of the operation. But she can be really firm too. And I'm just really excited to welcome Laura and ask you to welcome her with me. Thanks, Laura. Thank you.
Well, thank you guys. I'm going to sit up here, which is a signal that we're making this more of a fireside chat today. It's also a signal that if either A, I say something you don't understand, stop me and ask. Because just like many industries, investing is like alphabet soup. And sometimes I'll say something and you have no idea what it is. Please ask me. I do that on a daily basis, even in my normal job. Ask the questions, that is, not just give the answers. And second of all, I do hope you'll grill me on whatever topic I touch on that you find either interesting or want me to dive in more on. I figure you guys have enough lectures in your life that you don't need me just talking at you for an hour with a bunch of slides. So I'll try to think on my feet. If you can stop me, you get bonus points. But thank you guys for having me today. It's an absolute pleasure. Graham and I go back to what my kids would call the olden days, which actually predates my kids who are 10 and 12, which makes us both feel ancient, but delightfully innovative and young at heart. So it was a pleasure to be here as a student, as Graham mentioned. I went from here to New York City, and I'll just touch on my background for a couple more minutes to set the stage for what perspectives I've brought into venture, because that brings both depth and sometimes bias. And also as a platform for you guys to ask questions too. I've worked in a company as large as 250,000 employees worldwide and as small as 5 people. So it spanned really the gamut. I spent 5 years in New York City right after William & Mary, did some investment banking, spent a couple years at PwC's audit group to get my CPA license done. Side note, was in charge of mortgage-backed derivatives in the summer of 2008 through 2010. So for those who want to ask questions about that at the end, feel free to catch me. It was an interesting time. Stayed around for 3 more years at a private wealth firm that had 500 people managing one family's money. So this was a really interesting group in New York City. You can imagine that was like double-digit billionaires that had 500 of us just running around taking care of their assets. And I mentioned that mostly because I got assigned to the venture capital department, which was a little bit of a random draw, to be honest, but I got really intrigued by it. And the last couple of years I was there, I raised my hand and asked if I could get involved in their philanthropic efforts. So the family donated $50 to $100 million a year while I was there. And so I got to be part of a couple-person team that ran the family foundations and thought through how can we deploy nonprofit checks with as much thoughtfulness and efficiency as we do venture capital checks. So that all led to moving to Richmond, Virginia, and we went from thousands of venture capital groups to about 2 in town at the time. Joined Graham there. I think he was employee number 2 and I might have been 3 at NRV, which is an early stage venture capital fund. So 12 years later, we're of a similar size people-wise, but have grown a number of portfolio companies and funds. Those have been everything from $100,000 for a really early stage idea up to several $1,000,000 for what I would call more of a Series B. So pretty well-baked cake, almost profitable, but some things to work out. In 2023, so almost 3 years ago, one of our portfolio companies got into some challenging times, Farmer Focus. They brought in a new executive team to help turn things around, and the new CEO asked if I would come on as the new CFO. So I mostly mention that because now as an operator, I have a totally different perspective. And some of the things as an investor, I was like, this is so helpful for the company. And I'm like, that is so annoying. Why do investors do that? So I will be frank with you guys on what I see as the good and the bad on both sides of the dice. And feel free to ask me anything about that too. So the snapshot there is I came in 23. We were in really, really tight cash position, like barely making payroll tight. We were put in default on a loan, and fast forward a couple of years, we're now profitable. We've added a couple $100 million in revenue. We've gone from 600 employees to 1,400 employees, and we're the #1 organic brand in chicken nationwide. So it's been an exciting turnaround. Yeah, thank you guys. But also to the humbleness, learned a lot, sometimes learned it the hard way, got some things right, made a lot of mistakes, asked a lot of questions. So I'll start us off, and I'll keep track of time because I do want to leave time for questions. And as I said, please interrupt me as I go, otherwise we'll all fall asleep, especially with pizza. I'll start with a couple things. One is, what do you look for when you're fundraising? What should fundraising be for? Why should you possibly not take a venture capital check? And why should you think about cultivating a board that's the right thing for where the company needs to go next? So I'll try to make this a little industry agnostic. You guys can take this with a grain of salt. It is a little bit different experience if you're fundraising for an AI startup than it is if you're fundraising for an organic chicken company. NRV is industry agnostic. So I have served on boards of electronic medical record companies, wireless charging for electric vehicles, dump truck logistics, chicken. I mean, it's like honestly served a wide gamut. That has some good things. It's helped me have a broad generalist perspective, but it's a little unusual in the venture space. Usually investors prefer to pick one industry and be siloed and really know the industry well. our theory at NRV was a little bit the opposite. It was these young companies need a lot of help. And if we're in person, we can help provide that help better. And so we drew a couple-hour drivable ring around the Richmond area, which went all the way from kind of Williamsburg to Harrisonburg and Fredericksburg to Raleigh, and said, okay, any industry, but within that geographic circle. As we then raised a fund a few years later, it became nationwide and we got a little more focused on general consumer, but still, even within the fund, we have a 20% grab bag. So we have SVT Robotics, which is actually AI-powered robotics company in town, Iron Sheepdog, give Williamsburg a shout out, and a number of others. So it's been a blast. As I look across the different stages of fundraising, speaking mostly to you guys as students, founders, leaders, I would say pay less attention to valuation. Pay more attention to who is writing you the check and whether your vision for your company aligns with their vision. Where I have seen the hardest relationship between companies and investors, it was not, oh gosh, I wish we could have gotten 2% more or less on the valuation. It was, oh gosh, like I as the operator want to take this company in this direction, and they as the investors want to take it in that direction. And all of a sudden, I don't really have as much say as I thought I did over the company that feels like mine, but now legally is not all mine. So there are some really important nuances in a term sheet, which is essentially the economics an investor presents. So you kind of look around at this landscape and you say, okay, this group looks like it has good values, that group looks like it has good values, but I also want to know what are the economics. So that should arrive to you in something called a term sheet. It has a valuation, which is the price for your company. It has something called a liquidation preference, which is sort of entrepreneurship 201 or 301, and I can talk for when I taught a class here for a while, we spent an entire month on liquidation preferences because they eat founders' lunches more often than valuation does. So let's talk about that if you're getting close to raising. But it's essentially ways for investors to get their money back before common shareholders and founders do. It'll have things like voting rights. Everyone glazes over when you get to voting rights, but those are, I would say, one of the most important sections of a term sheet. It is very important who gets a voting right, who gets a say over what decisions will be made for your company. And the size of the raise. I think there's pros and cons to taking big checks as a young company. I find it's detrimental more often than not to take more money than you need. Occasionally that can work out, but often you should just take the money you need at the time you need it. As little as possible, be as scrappy as you can, get the model as far as you can on every dollar, and then say, okay, how much more do I need now? How much more do I need now? What are the milestones I want to get to with each of these checks? You might be saying back to me as an entrepreneur, I hate fundraising. It takes forever. That sounds like terrible advice because I'm going to have to fundraise 4 times instead of 1. And I would say back to you that if you do that, you'll end up at the end of the process holding more of the company yourself. So the value at the first raise, if you're going to raise $1 million over 5 years, the value of the first raise is going to create more dilution. That means you're going to have to give more of the company away because your company is just not as valuable, right? Maybe it's an idea on a napkin, it's a prototype, it's something young. And so an investor might say, okay, that's worth $2 million. I'm going to give you $1 million. I get half your company. But if you'd raised as little as possible, you do say 50K or 100K, maybe you give away 10% of the company. And then you wait a year, you get further along, you get customers, you get a pathway to profitability. And now you go to raise again and you say, you know what, I'm pretty far along. I'm not quite profitable in being there. Now my value is worth $5 million. And so maybe you need that $1 million now, but it's only going to cost you 20% of the business, not 50, right? And so the longer you can wait, I know as an operator, that's really painful because you're watching the bank account go lower and lower and lower, and you're like, oh, I really need to make payroll on Wednesday. So, don't let it get so tight that you close the doors and have to fire everyone. But I would say run it as tight and as lean as you can. And you'll thank yourself when you're 5 years, 10 years down the road and you own 60% of the company instead of 30%. I'll pause there for a second. Any questions on kind of that really early landscape of thinking about investors, term sheets? Yeah.
Yeah, so for starters, thanks for coming and talking to us. Great to get some insight into this stage of venture capital that not a lot of people hear sometimes. How necessary do you think it is for this fundraising process? Obviously, it's not a super common thing, but if a business is able to make their ends meet, they're doing all right, maybe they don't have everything they need to grow yet, but they're making it day by day. How important is fundraising to a business like that? Should they even consider it, or is it something that they can push off a little bit further?
Yeah, that's a great question. I'll answer you with 2 hats on. So with my investor hat on, I would say you should think about fundraising because investors can open doors for you that you may not be able to as an operator. If they have a customer Rolodex, or they can vouch for you and say, hey, John, I've got a great company I know, we're invested in them, please say yes to a coffee, they can help you develop whatever it is. Now, the investor, of course, will be biased, and I can speak as one because we have something called a deployment schedule. So you guys as companies have fundraising schedules, we as investors have deployment schedules. So I've got $50 million for my investors and it has to get put to use. And so I have a cadence at which I need to find a certain number of companies and deploy a certain number of checks, or else as an investor, I'm not doing my job. And my investors, because I've got investors behind me, we have a few hundred in NRV and most funds have more than one, will be saying, what are you guys doing? Like, I should just put my money in the stock market. Like, if you're not going to use my money, I don't want you to have it. Now, I'm going to take my investor hat off for a second and put on my operator hat. As an operator, I would say there's a lot of reasons why you should not fundraise. Be thoughtful about the timing of any partners who put money into your business. We've now been around for almost 12 years at Farmer Focus. The average lifespan of a fund is 10 years, which means like the clock stops, the pencil drops, you have to sell the business because now I have to get cash back to my investors. That can create a tension because as an operator, if it's been 10 years and things are going great, I don't want to sell the business. I want to keep running it, right? Like, why would I put in 10 years of hard work to get to great success and then have to stop the clock and sell the business for what as an operator could view as an arbitrary timeline, right? And I'm sort of making this up as an example, but it's a very real example across a wide variety of startups. And it seems so far away, right? You're like, oh, it's a 10-year fund, we've got ages. But I can tell you that 10 years comes up awful quick, and it can be in year 5 when they give you the check, which means you really only got 3 years, and then you've got to start running a sale process because that'll take a year or two. So be very thoughtful about when that money has to come back out if you really want that. And be really thoughtful about whether you want an investor at the table helping you make decisions. There are some great reasons to do that because they can have perspectives, long-term and short-term, that can give you wisdom you might not otherwise have as a founder. But they will also think they know a lot of things that they don't actually know very well. And so, and I speak as someone who sits on a number of boards, it's very tempting to be like, oh, this worked at that company, I'm sure it will work for you too, do it this way, right? That kind of copy and paste mentality can bring good, valuable like synergies and efficiencies, but it can also be kind of a trap where your investors are like, but it's always, but my deals that have done well have always done this. It's like, well, maybe, maybe not, right? Your company could be different. So I have seen some great partnerships. I have seen some really friction-laden venture and founder partnerships. And I'd love to say it's like 95-5 in the split. And I would say it's more like 50-50 at best, especially as time goes on and visions can differ. So all that, with all my hats off, I'd say don't raise until you have to. And don't take any money unless you need it. And if you do take the money, have a very finite sense of what you want out of it. Look at it like a ninja mission, right? Like, I'm a black operative. I need to go in and get something done and get back out again, right? Like that money has a clock. I'm going to go into my business model, drive these changes, make these innovations, reach these milestones, and then I'll have a plan to get the cash out before I even take the check. Any other questions on before I kind of move on? Yeah.
How often do you come across founders that just want to pay off their investors to keep the business running?
Yeah, it's happened a couple times. I would say the challenge is that from the investor side, it's usually more valuable to sell the whole business than it is to just take a slice of the business out to the market. Or you need a founder who has enough wealth to buy back that portion of the business. And then you often get into valuation arguments. And so, you don't really know what a startup is worth until you take it to market and run a full investment bank term sheet. I mean, that's an expensive process. And so what I often see happen is a founder would like the company back. The investor wants a much higher price than the founder either is able or willing to pay. And so then you kind of limp along for a few more years until you get the whole business sold. But the less capital you've taken, kind of the better in that specific scenario because it makes it easier to buy out. And I do sometimes see either redemption or buyout agreements at the start in a term sheet. So sometimes we as investors will put in something called a redemption right that says, hey, let's all get on the same page. On May 31st of 2029, this fund will expire. We'll have to take it to market or sell the shares. Let's all sign on to that before you even take the capital. So we would do that often on the NRV side, just to be totally transparent up front. And we sometimes both sign a side letter that's like, we've talked about this, we agree. Either we're going to set get like an independent appraiser in, and the company will buy the shares if they can, and if they cannot, we'll take the whole thing to market. So if you've done that beforehand, that definitely helps. It's a little bit like a marital prenup, just to kind of sets all the expectations out there. If you haven't, that sort of breakup of the relationship I see get often rockier.
I have a question, specifically around the relationship with the founder or someone that you're investing in, like. What signals do you find, or like the things you're like almost perk your ear, like, oh, this founder knows their stuff, and if you could just demonstrate that to people who are having that journey right now, what are those things that they should be signaling to you as an investor?
Yeah, interesting. This is counterintuitive, but I love it when a founder tells me I don't know the answer to that. Let me find out. I get conversely very nervous when founders have a pat answer to all the questions I ask. And when I say things like, what are your competitors doing and what are you nervous about? And they say, oh, they're way behind. I'm not nervous about anything. That's not the case. Whatever your company is, your competitors are out there. They're often smarter than you think. They're moving faster than you think they are. And you just have to constantly stay hungry to keep innovating. And so that sort of like, I know it all, maybe the founder feeling like they have to show a strong front to get an investor's attention. But the good investors will know that the best founders have transparency, authenticity, aligned values, and they'll tell you, I know this and that, I don't know this, but by taking your check, we could go figure that out together, right? So definitely don't make up answers, don't make up data. And it's interesting how it's just like human nature to want to know the answer to things and to want to, if you're not sure to kind of make something up. And we were actually talking at a recent meeting, it was like we set a standard of, if you don't know the answer, say so. And if the data's not right, don't talk to it, right? It sounds simple, but it's something we've had to keep like rebuilding into both operating and investing culture of we don't know all the answers, especially in today's world when AI is changing it so fast. I think there's a lot of opportunity with AI. And I also think there's a lot of challenges with it because it means most startups can be much less cost intensive with AI. You can use it to create code that you would have had to hire 4 people to do before. On the flip side, your competitors have that same tool and access, right? So you're always kind of wondering, I can go a lot faster and a lot leaner, but everyone else around me can too.
Thank you so much.
Yeah, I have a couple of questions. Like, so for example, there is a startup story and there is numbers. So what if the story doesn't necessarily translate into numbers? How do you evaluate those startups? Like, so what happens? Because there is, and then more so, my second question answered to this. Like, so the thing is, what guardrails you will have for the founders? Meaning, like, so for example, in some startups, the story doesn't translate into numbers, and the venture capital comes and invests in that startups. That founder might be always looking for an exit. Like, so how do you protect that business, and like, so how do you take it from there?
Yeah, I'll take this in 2 pieces. So remind me of the second question if I answer the first one and forget what you asked me. The first question was, how do you assess a startup where there's a story and not numbers? I would say back to you that even a startup with numbers, I don't necessarily believe their numbers. I could go back 10 years and give you lots of spreadsheets, and every single one, everyone in the charts, it always goes like this, and the reality is like, it's like a spaghetti noodle and you're like generally trying to like trend up. But every single graph I've ever seen from a startup, it was just like, oh, we'll grow everything 30% a year and it compounds. And then we're $1 billion company in 4 years. So delightful if you end up doing that. But I have yet to have a startup actually exactly aligned to the numbers they gave me. So I actually mean that in a weird way as a piece of encouragement, which is focus on the story and your competitive advantage. If I could give advice, especially to young companies, I would say focus less on the size of the market and the market problem. As an investor, I would often see more than 1,000 potential startups a year. Like, I believe you when you tell me there's a market problem. You don't need 4 slides to show that it's a $1 trillion issue, right? Like, I can conceptually understand that there's a problem or there isn't, especially if you can show the market's like asking for this versus you sort of trying to push something on the market. You don't need to give me a bunch of data about, many markets I've seen in slides are 100 billion or $1 trillion markets, but that's irrelevant to me, right? Because I'm not going to sit around and say, are they going to get, in 5 years, will they be 10%, 12% market share, 15%, 30%? I don't know. I would not have said 10 years ago that organic chicken was an exciting, interesting market, but it's been a fantastically successful company, and it's just been a blast working there too. And we've outstripped by like 3 or 4x the size of the industry growth overall. So don't spend too long on the industry itself, that sort of generic knowledge. Spend your time on how your company makes a difference and your team. I have sometimes learned the hard way as an investor that if the team is not good, the best product won't go anywhere. And if the team is looking to get out in a year or two, the best product does not have time to grow up and be sold. And in fact, the opposite can happen where there becomes sort of tension and fighting and lack of direction and inefficient use of capital. So do spend a lot of time talking about you as a founder, your co-founders, why you as a group will gel well together and not get in each other's way. And if I could pick one financial metric for every startup I looked at, I would choose 2 that are non-financial: curiosity and low ego. Like if you're a curious person and you have a low ego as a leader, you can get a whole lot done, even if you don't know a lot about the space. And I include that in my hiring. I do quite a bit of hiring. I cover accounting, FP&A, but I also cover HR, legal, insurance. Like I have a pretty wide number of hats I wear on the farmer focus day to day. And that is what I'm looking for when I interview. I can teach you the spreadsheets. I can teach you the consumer world. I cannot teach you curiosity, hard work, and a low ego approach to being with teams. I think I forgot your second question, which I knew I would. What was it?
So my thing was like, so the startup founders always sometimes look for an exit. So they
Yeah,
always
looking
want
for
to
an exit,
exit the
yeah.
company. So what guardrails do you put so that they stay with the company, so their expertise is used for their business?
It's a good question. I'm not saying this is always the case, but I more often find that investors want to get out before the founders do. So usually you get a couple years into a product. By nature, a founder either loves the product or they don't. And if they don't love the product, they're probably not going to stay anyway. So it's less a matter of like, let's sell this thing and I want to go on to the next. It's more like, you know what, I tried the startup thing for XYZ reasons. I don't like it and I want to move on. So I haven't run into that issue as much. Investors are less likely to guardrail against a founder leaving early than they are against a founder hanging on too long. Graham will remember this, but one of our founders in RV used to say, entrepreneurship is French for being unable or unwilling to let go. And as investors, we were more focused on coachability and getting it to the right stage and selling it. I will say if founders need exits, it can be a flag for investors because the question would be why? You know, are you just in it for the monetary gain? If so, there's much easier ways to go make money. Are you in it for a quick flip? That actually might not be good for investors because they have something called an IRR, internal rate of return. And in most funds, you can only invest once, like you're not allowed to recirculate investment dollars. So you don't get multiple bites of the apple. So I would actually rather have a 6 or 7 year company in my fund than a 1 year make 5 or 10% because I want 6 years. I want that big step up. I want to show my investors that it was worth putting their money in the fund. And if you're getting these quick flips, generally I have to get that money back already. And then the fund's done in like 2 years instead of 10. So it's not necessarily a no-no. And if you think you are a founder and you only want to do it for a year or two, just be really upfront with that. Because there can be, especially if you can find investors that aren't locked into a fund structure, like friends and family, smaller checks, they may be very happy to get their money back in a year or two, even if it's only grown 10 or 20%. So just be very thoughtful and very transparent about what your timeline is and what your investor's timeline is and match them up. And it doesn't have to be from a fund. You know, frankly, friends and family, those smaller are often a lot more flexible.
So like at what point in their ability their product or this is looking back starting or investors more like that next step?
Okay, so the question, if you didn't hear it, is at what point should a founder start thinking about whether they'll want investors? I think while I do think you can raise too soon, I don't think you can start thinking about raising too soon because a lot of times your model and your product will tell you whether you have to fundraise. So if you are making a physical good and you need manufacturing space, you're probably going to have to fundraise. It's going to be really hard to get any sort of loan on an idea. And so you're going to just need the investor. It's more capital intensive. If you're a software platform largely reliant on, say, AI to help you ramp up, you may not need it for a while. And then the question would be, okay, how far can I get? You know, if I'm unpaid, how long can I live my life without getting a paycheck? You know, just think about those really kind of practical day-to-day things. Like, when do I need to start drawing a paycheck? How much does that paycheck need to be? And then line it up with your product development roadmap. So if you think you've got something really scrappy, you can start getting customers in a few months. you might be able to do it without it. I'd say give it a shot and try it. And even if you can get early data in those first few months about, hey, I only got a handful of customers, but it cost me X dollars to get them. They stuck around for Y months, and that returned Z dollars to my potential bottom line. You've learned a ton, right? So if you can build something really easily, if you can deploy it low cost, and if you can get money back without a lot of fixed costs, you might have a shot not to have to fundraise. But most startups do need it, if for no other reason than like they need to start drawing a little bit of a paycheck. They need to do some trial work on customer data. They need to, there's a million other reasons why you might want to. So it's so intrinsic in the model of the thing that you're building itself. Like how quickly will it start to kick off cash versus how quickly do the upfront costs hit and matching those up. But it can't hurt to start thinking about it right away and asking questions. Most investors are like happy to answer questions, hypotheticals, like it's part of their business development approach to know young startups. Iron Sheepdog was a great example. They've taken rounds from other checks. We were their first institutional capital, probably because I just met Jake through a friend and he's like, I've got this pilot thing going. And I was like, that's pretty interesting. And so they were an early check for us, but it's been an exciting company to watch. So you never know when an investor, that was actually earlier than any other investment we've made. You never know when an investor will be like, you know what, this team has something special and we're willing to bet on them.
Or you give us a teacher's student first off moment in patient preference. And curious if you can go into a little more detail about scenarios and experience to tease that out.
Yes, if you want the full download, find me later. I'll apply names in a way to what I will give as anonymous examples right now. But I will say I've been through a couple knockdown, drag out transactions that revolved around unintended consequences for liquidation preferences. So what is a liquidation preference? A liquidation preference is the right of an investor who typically has something called preferred stock to get their money back before the holders of the common stock. So holders of common stock think founders and employees. Holders of preferred stock think investors. And this is not like a public company where each share is exactly the same. So if you go buy a share of Google and I buy a share of Google, we have the same thing. If you buy a share of common stock and I buy a share of preferred stock, we do not have the same thing. We do not get paid the same amount at exit, and we do not get paid in the same order. So liquidation preferences are often ways for investors to get, it's called downside protection. So if things go poorly, they have a way to get their money back, and potentially founders can end up with nothing. I have seen liquidation preferences go as high as 3x, which means if an investor puts $1 million in and your company sells for 3 million, they get 3 million back and the founder gets nothing. I have been through a couple transactions like that, and the investors got paid and the founders literally got $0. And you can imagine in an exit process, that's pretty tense. That's the investor saying, we're worried about this company. You have to sell it. You have to take this deal. And the founder saying like, I guess if I have to, I have to, but like, why would I sell this thing and end up literally with nothing? So those are the mechanics of liquidation preference. They seem very innocuous when you sign the term sheet, because when you sign a term sheet, by definition, everyone is very bullish, right? The founder is thinking up and to the left on the Excel charts, up to climb the mountain and hit the summit. And the investor is like, we're excited too, let's go. We won't need this thing. But fast forward a few years, if the market changes, if you run out of money faster, if you can't fundraise again, I have seen probably about 50% of the exits that we've been a part of, the liquidation preferences have mattered. There's also an interesting striation inside investors. Each round doesn't have to have the same preference. So I've been a part of a couple deals where NRV might have been a Series A investor. We did not put a preference on, but an investor came along in Series C and they did put a preference on. And in that case, they took a 3x. So there was this big range where all the money went to the C's, and then it would go to the B's, and then the A's, and then the founders. And we had 2 term sheets, and one term sheet, I'll make up numbers just as an example. One term sheet was an exit value of $100 million, and the other term sheet was an exit value of 70. The $100 million, you're like, of course, take that term sheet, sell to those people. But the Series C investors wanted the 70 million term sheet. Why? Because their payout is fixed. They're getting 3 times their money back. So now they don't really care what the number is above the amount they'll get back. They want a deal that's very likely to close. And so they said, we want 70 million and we want certainty. And we as the investors on the A side and the founder side said, no, we want 100. Like, even if it's a little less certain to be done, even if it's a little bit more of a long shot, like we'll get way more money. They said, nope, we've got governance rights, voting rights. We can choose the term sheet and the exit. We're taking the certainty, we're taking our 3x, and everyone else on the cap table got a lower number. So it sounds like some sort of Wild West, but it actually does happen. I've been through a deal like that. And the midterm in my class was to line up 4 term sheets, run the liquidation waterfalls, and say, as an investor, as an independent, as a board member, what deal would you have chosen and why? And so that's one of those just real life things that, because it's such a tricky one, if you could think about it in the early stage and just be very upfront with when do you need your money back, make those liquidation preferences as low as possible, not participating preferred preferably, which we can talk about later, set yourself up for as much success with as much optionality as you can.
You can speak to another element of that, like down rounds and double ratchets.
Yeah. Down round protection is another thing that very few people, when I was investing in kind of 2013, when I started in RV up to 2021, I can't think of a single person that asked me about down round and ratchet formulas. From 2022, 23 to present, lots of questions about down round and ratchet formulas. And it's not, I wouldn't say it's the fault of the founders either. We had a really bullish period in venture capital, really, especially around 2020 and 2021. We had a young company that got offered I want to say it was $250 million valuation, and they were barely out of pilot stage. We were an early investor, and I literally turned to my colleague and was like, that's crazy. It's absolutely crazy. I mean, good for the company, I guess, good job. Take the deal. But fast forward a year after that, the fund that made that investment at the sky high valuation starts to get distressed. They had to write their investments down significantly. This happened to be a technology company. The valuation in the markets turned a lot in 2022 and 23 downward. And now they're looking hard at their down round and ratchet math. So down round, to just explain for those who haven't been through it, is when the price of your shares go down and a new investor makes a new investment. Down round protection can force you to reprice all the shares you already sold to everybody else. So this is not a public company thing, but it is very much a startup thing. And there's different ways to calculate it. So if someone's asking you for a full ratchet and you're a founder, I would advise you to say no if you can. There's something called a weighted average ratchet. That's a little more fair. But once you've signed that document, there's not much you can do around it, and it can be really tough. Now, I will say, if you are a founder, you didn't know, none of us knew, you signed on to a full ratchet, your valuation went down, that means you've gotten way diluted. You had to give a ton more shares back to everyone else to make their price equal. One thing I would say you could do is to go back to the board and say, look, this down round wasn't necessarily the company's fault, right? Take the example of the one where it was that valuation's outlandish. I mean, take it if you can get it. And it came back down to earth, right? That doesn't necessarily say anything about the founders and the company. That just talks to market conditions. And so as a founder, we've had once or twice where a founder comes back to the board and says, look, I used to own 20% of this thing. Now I own 3%. You as an investor should want me as a founder to continue to want to work hard. That means I need more skin in the game. Let's award some options. So we have seen scenarios where boards will kind of refresh the option pool and give options back to founders. It's not a perfect solution because now you're into strike prices, investing, and we can talk about all that to the extent you guys care. But down rounds are pretty rough. And I think if you talk to somebody who's been through a down round, they would say to the young founders, you may want to rethink that venture capital check or be very thoughtful in how you phrase it.
And I think just to add to that, having gone through it, always remember you can renegotiate anything. Might not have a position to renegotiate, but if you do.
Yeah, that's great advice. The founders don't hold as much legal leverage once you've taken investment, but you hold a lot of qualitative leverage, which is most investors cannot drop everything and step into your shoes to run a business. And so being frank with them that says, hey, if I walk out the door, this thing goes to zero, or it's going to struggle a lot until you find a new version of me. Let's just have an honest conversation and try to make this a little more fair. Yeah.
I'm curious if you're seeing more companies doing seed strapping, right? Where they're just gonna keep the team really lean, use a lot of AI and raise a small pre-seed or seed round.
Yeah, I definitely am. And I'm also seeing investors less likely to cut early checks. So a lot of startups are trying to do that sort of seed strapping thing and take really tiny dollar amounts and grow it. And I'm also seeing investors getting a lot pickier on how far along the investments are before they're willing to cut a check. So maybe that's a good thing because at the end of the day, you haven't had to fundraise as much. but it can also be a really challenging thing because it feels like the sort of circular reference for founders, I think. And I'll tell you one sort of funny side note, which is as an investor, I was always like, it's not a no, it's a not yet. You know, here's some things to come back with. And now as an operator, I'm like, oh my gosh, if it's a no, just tell me so. You know, don't make me go through this like 100-point diligent list. And as an investor, I was like, oh, this diligence list is 100 items long. That's very important to protect the fund. Now as an operator, I'm like, oh my gosh, 100 like diligence items. Like, do you not know that I'm running a business? So it's I appreciate the irony from my own seat on knowing why the investor is asking. They do have a duty to their investors, and yet knowing like the things that drive me nuts as an operator sometimes. If you know it's a no, just tell me. Whereas an investor would say, well, I need to cultivate a pipeline and I want to stay in touch. And, you know, it's like, just tell me your metrics. So I sympathize, but I do think it's been, I'll be honest, it's been a tough couple of years for venture and it's been a tough couple of years for fundraising. A lot fewer deals have gotten done. The valuations have been a lot lower. I think as a consumer, that's not always a bad thing necessarily because it's forcing the strong to survive. And in 2020, 2021, a lot of like not very good competitors were getting funded with huge checks. And when you're really good at what you do, and you're like, how is that company over there that has a terrible model like stealing all my customers? Because they had an endless venture capital check in their pocket. That to me sort of distorts the marketplace and makes it hard for really great companies to survive. So in the long term, in a weird way, I'm glad it's correcting a little bit. I think there was just too much money from venture capital flooding all these companies and sort of falsely propping up ones that hadn't really figured out their model. But on the flip side, for founders and as investors, it's made it really challenging. And you didn't ask this question, but I'll say it anyway. I don't think that's likely to change for the next few years. Not everyone understands, but venture capital is very sensitive to interest rates. You wouldn't necessarily think that, but when interest rates go up, it makes it really expensive to not give cash back every year. So if you think about my investors have money in the S&P 500, right? They can get it out anytime they want. And when I fundraised them, I said, you know what, I'm going to take your money for 10 years. Just say goodbye to it. Hopefully I'll give it back to you. I'm not going to know anything for 10 years. I'm going to make up some valuations in their own because I don't know the market prices and come back in a decade, right? And so it's a tough sell. At the time, interest rates were like 0.5%, right? And so they would say, well, you know what? I can't leave this in the bank. It's not doing anything at 0.5%. I'm willing to take the risk on you guys and invest. But fast forward to today and have that same conversation with an investor, right? Any investor, not just one of mine. They would say, you know what? I'm making 3.6% in my risk-free, highly liquid money market account. I think I'm good, you know? Like maybe if you have something extraordinary, I'll put it to work, but the threshold for putting money to work is higher. And the higher interest rates, we can talk finance nerd math, but the net present value gets driven down.
So that's pushing, you said the check size maybe up, like how low they're willing to go, the venture capitalists to invest in a company, like maybe not a couple $100,000, maybe they're only willing to do 500,000, right, or $1 million investment. Is that kind of what I'm hearing?
Yeah, partly so, partly at stage. So let's say I'm putting $100 into a startup and it's a little baby startup and it's going to take 10 years and hopefully I'll get $500 back, right? In the olden days when my cash was doing nothing, the opportunity cost was almost zero. So fine, lock it up. I lost what, 0.5% for 5 years? Who cares? But now if I put that same $100 in and I'm only going to get 300 back in 5 years, I've lost 3.6% compounded by 3.6% compounded by 3.6%. Like my cost of locking it up is a lot higher. And so that means as an investor, I'm more likely to invest in things that are profitable or almost profitable because that cash is going to start coming back to me sooner. The stakes are higher to lock it up, so I want it back sooner. Or I might just put it in a more mature dividending company, or I'm going to put it in a really late stage about to IPO company, right? Like I'm going to bias myself towards later stage companies, and those are more expensive. I have fewer checks, therefore, and I write bigger ones. I'll say the exception is there's always like certain darlings, and AI has been that for the last 3 or 4 years, right? And now we're seeing some correction too. Like if you follow some of the IPOs that were software based, like they have taken a beating in the stock market. One of the IPOs was up 250% late last year. It's now back to its IPO price. So there's a rough world out there in startups. People are just assuming AI is going to come and be a tough competitor. So when you get like a darling, they defy the rules on stages of checks, but then you get a lot of volatility because once you're not a darling anymore and you have to normalize back to where everyone else has been living, it can be kind of a rough ride.
I was curious about farmer focus. Got there was a mess, turned it around, great story. What were kind of like a couple of bullet points of what was wrong, I guess?
Yeah, happy to. And it's 5 to 1. I know some of you guys have class, so I will not be offended if you pop out. If you want to chat more with me, feel free to ask Graham or any of the staff at the Entrepreneurship Center. They'll share my email and I'll keep chatting, but feel free to get to class if you need to. But to answer your question, so we had a pretty significant amount of work to do on the turnaround. We needed to redo our sales mix, we needed to redo our fixed costs, and we needed to redo just a lot of, I'd call them more cultural opportunities. And I think I'll try to make these general enough to apply to startups that are maybe struggling too, and the types of things, because I imagine not many of you are thinking about organic chicken as much as I am, but I'll cast it in a light in which if you're either thinking about a startup or in a struggling startup, like what would I give as advice to apply? We took a look at every single area of the business. The very first one was just because we did it before doesn't mean that's how we're going to do it now. And frankly, we had to go through a number of our leaders and say, are you willing to do something completely differently and take some advice that may not make sense short term? And some of them said, nope. And we said, well, unfortunately, like we need a team that's going to go forward with us, so we'll do that. So we turned over half of our employees. And I don't say that because I'm happy about it, but I do say it because it speaks to the importance of culture and just a willingness to kind of innovate and do things differently, because we truly had to do things differently. We also changed our customer mix. We did this slowly because you can't just turn off a bad customer, but I think most startups have that customer or customers who are like, gosh, I wish we hadn't given them those contract terms. Gosh, they did a lot more work than I thought. Gosh, they call me 50 times a day and they spend $1,000 on the platform every week. We identified those as a group, as an executive team, and said, these are the group we want to get rid of. And who are our dream customers? These are the ones we want to secure. So we couldn't cut off the sort of problematic ones because we were already losing money and that would have made it worse. But we went after the dream ones, and it took 6 months to a year, but for every dream customer we got, then we would turn off a couple of the problematic ones. And we would just go and say, hey, I'm sorry, we can't service you guys anymore. Or if you'd like to come at our new pricing standard, you're welcome to. So we did that very thoughtfully, but we also went aggressively. Like for every sort of poor customer we could turn into a dream one, it was a big step up. We also took a look at our fixed costs. So we're in processing and manufacturing. We have a lot of fixed costs, think buildings and machines and all that. That's its own sort of challenge. But we said the more we can run through those, the less it costs per unit. So previously they were running barely a shift. We took them to 2 shifts plus weekend work. Now that's counterintuitive too, right? If you're losing money, why would you do more of the thing that you're doing to lose money? But for us, it meant that the cost per pound went down like 70%. So now the revenue is going up because we're getting dream customers. The cost is going down because we're running a lot more volume. And then we were running a culture of ownership inside all of those things. So we literally went line by line down the financials, 200 line items. And we said, who can own packaging waste? Who can own rental trailers? Who can own transportation? Who can own interest costs? And we met every single week with those owners and said, we're not waiting to the end of the month. We don't have that kind of time. How's it gone this week? What went well? What didn't go well? We're not blaming you. We know it's going to be hard, but just be transparent with us and we'll be transparent with you. I also met, at one point, 3 times a day on cash. So then on the finance side was the third wheel of the stool, because cash is king when you're in a startup that's having a tough time. And we said, what payables can we stretch? Or who do we need to buy from that has us on hold because of credit? Okay, we're going to pay just them, just enough to get one more shipment, right? So thinking like very sort of specifically and tactically versus, okay, we got some money, we'll pay everyone 10% of what they're due. No. If I don't need anything from you, I'm going to call you and tell you we're working on it and tell you I will be thrilled to pay you back as soon as I can, but for now you get nothing. And from the person I need a shipment from next week, I'm going to pay maybe the full bill so that I'll convince them to ship again. So it took a lot of transparency. We went through a lot of challenges, and I'm happy to chat more about it, but we've come a long way. So I'll tee up Graham because I know we're getting a little close, T-minus 2 minutes, and I'll hang around after to come find me.
And that's why Laura's on the dream team. I told you she was wicked smart. We're just about at time. And so I want to make sure that we stop here so that you can come up and introduce yourself, meet Laura. She meant it when she said, please connect with her. I'm going to support that by putting her LinkedIn profile here. So scan that. You can connect with her. We can also facilitate that connection. But thank you so much for spending time with us, for sharing a little bit of your wisdom about this space. I get the sense that we could have talked for another hour, So come up and chat with her, but join me in thanking Laura for being here. Thank you.
Thank you, guys.
All right, that's a wrap for today. I think there's maybe some leftover pizza, so grab it if there is, and make sure to meet Laura before you leave. Thanks, everyone.